Okay, part two on common stocks. Let's continue talking about some of the characteristics of stocks. There is one other kind of stock, I guess you can think about it, something called a classified common stock. And essentially, this is where one company might have more than one class of stocks. As you see down below, it's Facebook issued Class A and B shares. Class A shares were available to the public. Everybody gets one vote. Class B shares were held by the CEO and some other insiders. Now they receive 10 votes per share. So obviously it's just a different way of issuing shares to a differing kind of clientele, if you will. So in this case, the insiders and the CEO of Facebook obviously kept a great deal of control, even though there were, literally millions of shares sold. They maintained some control with their advantage on voting. So let's take a little break, talk about how stocks are sold, and particularly we'll start with the quotes, right? Obviously, you see quotes all the time in the newspaper. Market capitalization is frequently discussed. That's the total number of shares that are outstanding multiplied by the share price. So this is, if you wanted to buy all of the shares of the company, this is how much it would cost to buy the entire company. So if we look at a stock quote this comes from Yahoo Finance. This is obviously Harley Davidson. On this day, you see it's $42.85. It was up 11 cents. That's 0.26%. And on this page, we can find lots of information, obviously, about the company. This is a website. All of these links here are links to information about Harley Davidson. But just a couple of things that's nice to point out, right? Here's what the close was yesterday, right? 42.74. It's up to 42.85. That's the 11 cents. Here's the market cap. This company today is worth $7.068 billion. We have something called a beta. We've talked about that. We know that's a risk measure. Here's earnings per share. Here is information about dividends, right? They also are providing us with a 1-year target estimation. So they're saying in 1 year, they estimate the stock price is going to be worth $47.58. So they're, at least on this page, they're predicting an increase in the value of this company's stock. So speaking of value, let's talk about different ways to address the word value. There's something called the par value, which is really just an accounting number, right? It's used to journalize common stock transactions on the accounting books. It doesn't mean anything else. It is just a number for the accountants to use. Book value, though, again, is an accounting term, and it's the difference between the company's assets and liabilities. Now, the challenge with book value is it is looking at historical data. So it is there is a backward-looking estimate of the company's value as of the date of the statement. Market value is forward-looking. It reflects investors' expectations about how the company is going to perform. It is a function of the supply and demand mechanism for the company's stock. Now, some of the things that we want to look for, and we'll talk about these in some later videos, is the relationship of the stock price to other values, right? If the stock value is less than the book value, it might be an indication that this company is in some form of distress and really doesn't have a lot of good prospects. Investment value is the amount that investors believe the stock should be trading for. It's what they think it's worth. And everybody is going to determine this. We could use lots of techniques, some of which we'll talk about in this text, in these videos. but it's a fairly complicated process. All right, but this is a picture in an investor's mind of what they think the benefit is of buying this stock. Now, if you compare the benefit, the investment value, to the market value, we can now make decisions about buying and selling stocks. So, shifting gears again, let's talk about dividends, right? Dividends obviously is income. It's one of the sources of returns to investors. It's a lot more predictable than capital gains is going to be. And right now, current tax laws put dividends on the same playing field, if you will, the same tax rate as long-term capital gains. So the tax rate between the price appreciation and dividend income is really inconsequential. It doesn't really matter. It's the same. So investors shouldn't have a preference of one over the other in their investing strategies. Some things we can think about. Number one is who makes this decision, right? The dividend decision is made by the board of directors. They determine what amount should ultimately be paid out. So some of the things that they think about or consider, number one is profits. And of course we have earnings per share. In this case we have a formula. It's net profit after taxes minus the preferred dividends divided by the number of shares that are currently outstanding or being held by investors. So this is our typical profit number. So what affects these numbers, right? So growth prospects, right, is going to affect how they make their decision. If there are a lot of growth opportunities, they would rather hold back cash rather than pay cash out to dividends because they want to buy this future growth. The amount of cash they have will certainly have an impact on whether dividends are paid, and certainly the amount of dividends. They have loan agreements. There might be something in some of our contracts that limit how much we can pay. But quite frankly, in the end, one of the key characteristics or one of the key factors is, how are investors going to react to changes in dividends? So if we do make changes, what do the managers of the company expect to happen to the way shareholders view the corporation? And of course that will have an influence on whether they want to change or not. There are some important dates that are important. The first date is the declaration date. That's the date that they make the announcement that a dividend is coming. So in that announcement, there are two things that they tell us. Number one is they tell us when the dividend will be paid. That's the payment date. So on June 3rd, they'll say, we're going to pay a dividend and you'll get your check on the 30th of June. Now, who is entitled to get a dividend? The next date that they mention is something called the date of record. And the date of record says if your name is not in the corporate register on the 18th, then you will not get a dividend. So all shareholders as of June 18th will receive a dividend on June 30th. Now there is another date. It's called the ex-dividend date. And this is just a 2-day date that gives us some time for the dividend or for our names to ultimately get on the register. So if you bought the stock on the 17th, your name wouldn't make it into the register on time. You own the stock, but this person here that still has their name in it, they're going to get your dividend. So when you buy this stock because they're going to get your dividend, the dividend or the stock price drops by the value of the dividend. And this is just to make sure that the person who owns the stock really gets credit for the stock regardless of where their name is listed. Two primary types of dividends are cash dividends and stock dividends. Now, cash dividends, obviously in cash. Stock is paid out in the form of stocks. There are rare times when other things might be paid out as a dividend, but it's very seldom. And in general, cash dividends are the most common. They tend to increase over time, typically have a growth rate of 3 to 5%, which seems to be sort of in line with inflation. So if you think about cash dividends, there's a return. The dividend yield is the return compared to the dollar price. So you take the dividends per share divided by the current stock price. That is the dividend yield. That's the return you receive on this current dividend that was paid. The dividend payout ratio measures the percentage of earnings that a firm pays out in dividends. So you take the earnings, which is all the money that could be paid out. If you divide that by the dividends per share, that gives you the percentage that was paid out, right? The dividend payout ratio. Now, 1 minus this, of course, would be the amount that was kept, right? So earnings per share is the 100% mark. Some of it was paid out as dividends and some of it was kept. This is the proportion paid out as dividends. Now, a stock dividend, again, is just a distribution of shares. So a 10% stock dividend would mean you would get 1 share of stock for each 10 that you owned. Now, this is not really a dividend, right? This is really not a change in ownership because everybody gets the same 10% stock dividend. And now, unlike cash dividends, stock dividends, and later we'll talk about stock splits, those two things are not taxed until you actually sell the stock. So there are companies that actually provide a service. It's called a dividend reinvestment plan. So what this is the corporation sponsors a program where when you purchase shares, when the dividends are paid out, instead of sending you the dividend check, they merely reinvested in more shares of the company's stock. And again, it says here there's about 1,000 companies that offer DRIPs, right? It's convenient, inexpensive way to accumulate shares. Usually there's no brokerage fee, so that you're going to save some fees. And quite frankly, because they sometimes you won't have enough money to buy a whole share, they might allow partial participation. So you might be able to own a fraction of a share. Now, the one thing that's a little different here is that even though these dividends are reinvested, you're still going to be taxed on them just as you received the dividend in cash. So you will pay taxes, but your equity is going to grow in the company. So that's the end of video 2 on common stocks.